What would be the ideal outcome of the discussions on international capital standards?
The ideal outcome of the discussions of international capital standards would be the creation of a uniform measure to assess the relative capital adequacy of internationally active insurance groups. You know, the standard must be appropriate for insurance and should complement, but not undermine or replace, the legal entity capital requirements in the various jurisdictions. And the standard must be recognized and utilized as just one of the many critical solvency supervisory tools available. If we proceed deliberatively and thoughtfully, with the primary focus being on the outcome or the result and not on meeting some arbitrary deadline, I firmly believe we can develop an international capital standard which meets all these criteria and which promotes a stable insurance market.
Ideally, there should be a common capital metric in Europe, the Americas, Asia, and the rest of the world for the insurance industry. We have not been able to have today a mutual recognition of the solvency regime in the US and the solvency regime in Europe or in the rest of the world. And therefore, we have to invent a new capital standard. This is challenging, and the effort of the IAIS in terms of designing a global capital standards deserve recognition. Second, insurance capital standards should faithfully reflect the reality of insurance company risk exposures. As you know, for me, the best way for an insurer to accurately measure its risk is to use an internal model. Therefore, as far as I'm concerned, I believe that an ideal global capital standard would rely on internal models, at least for companies, of course, able to build these models.
One of the ideal outcomes would be to have more common supervision internationally for international active groups. It's definitely the case that capital requirements will need to be set internationally at group level in order to have more effective supervision. And this will deliver, definitely at the end of the day, for the benefit for consumers and for financial stability worldwide.
Well, this is a very interesting conversation because as colleges has evolved, as we've tried to regulate internationally active groups and had to have different national regulators talk to one another, one of the challenges they're having is they don't have the same way of looking at capital. So we can understand why there's this new demand for some kind of international capital standard. We do have to find a way for those colleges to function. I would like to think we could develop this in an evolutionary way. I think it's critical that we take care. We don't create just another layer of capital requirement. I think that'd be a very poor thing to do in a sector that's performing very well.
What needs to be avoided at all costs?
I think we need to avoid the situation like we have right now, of course, of very divergent requirements internationally. That creates situations of regulatory arbitrage that we should avoid. And looking forward, I think we should definitely avoid the duplication of requirements, so that international requirements should at some point in time substitute national requirements in order to avoid, of course, double burden for the industry.
Whilst I fully understand the need for the basic capital requirement to remain simple, I also think that this should not be oversimplified. In particular, we should avoid designing a capital standard that does not properly reflect risk mitigation techniques such as reinsurance. This is true for proportional reinsurance as well as non-proportional reinsurance. We should also avoid designing a capital standard that does not fully recognize diversification benefits, which for me lie at the heart of any sound risk management policy. Insurers that have been careful enough to build a diversified portfolio, more diversified than their peers, should receive more diversification benefits. Lastly, we should avoid piling up new capital standards without getting rid of previous ones. You know, today, the insurance industry uses too many different notions of capital. We have statutory capital, we have IFRS capital, we have US GAAP capital, we have economic capital, we have regulatory capital, we have S&P capital, AM-Best capital, and we have also capital as defined by the other rating agencies, and the list can go on and on. I hope, and that's my wish, that if a global capital standard were designed, one would expect rating agency models, for instance, to use it as a benchmark. So yes, we have to move to this international metric, global metric applied everywhere in the world to all insurers and reinsurers, and hopefully that will be, from now on, the basic to assess solvency.
You know, as the international capital standard moves forward, I believe that an overly prescriptive, universally enforced, rigid framework focused exclusively on capital levels must be avoided at all costs. Such an outcome could likely trigger 3 unintended consequences. Supervisors will be always fighting the last war and not have the critical non-capital solvency tools needed to face the future. The likelihood increases that the supervisory framework actually creates a new systemic element to the industry. And lastly, the framework will stifle innovation in new products and curtail growth in both emerging markets as well as developed markets.
I think there's a couple of things. Number one, you can't just add another layer of capital requirement. You know, we already have sufficient legal entity requirements. We're going to have to be very thoughtful about how we address that. I think another thing you don't want to do is pick winners and losers in the marketplace. And finally, you do not want to make capital so dear that the only way people can compete is by scaling up and scaling up and scaling up. If you do that, then you have nothing but a giant, effectively a utility with only the great big companies left, and we've lost that spark of innovation that solves society's problems. So we've really got to be thoughtful about this, or we're going to create some real distortions that we aren't going to be glad we did. We need to remember, in the end, the insurance sector is performing well.